So welcome again, guys. Let me give you some of the high topics. Todd, I'm going to have you mute yourself unless you've got something going on your end. Let me just give you guys what we're going to go over. I've got some really fun topics. As it said in our video, that there's nothing here that's trade advice. So obviously do your own research, but I'm going to give you some pretty good tips on some market things that are happening now, things that I would be watching, and some fun ones that you could look into if you're trading the market, buying or selling stocks. I saw some pretty significant, pieces of data that I think amount to good trades. But let me give you the topic. So one of the things we're going to talk about as a highlight is how the U.S. has downgraded its existing Fitch ratings. So Fitch ratings just came out, and you could say the U.S. credit score has just dropped once again. This is the second drop that we've had in the last 12 months. One of the other things we're going to talk about is what the Michigan man, the CEO of Berkshire Hathaway, Warren Buffett, and what he is doing right now in the last quarter, and some of his moves that I think are pretty telling into what he's projecting the future is going to look like over the next couple of years. Then we're going to talk about China's market and the real estate crash that's happening over there, along with some other factors, because China's market is extremely tied to ours. Week that completely shook U.S. markets, even though China is on the other side of the continent. We're going to talk about Palantir, which is an AI stock, some insider information that came out that I think is going to be, I think is immensely valuable, and most people don't know about this yet. So I think there might be an edge there, whether it's to short the stock or to wait for it to come down to buy it again. There's some stuff with Palantir that I think you're going to want to hear about. Because I do the second Friday real estate forecast, I'm not going to touch on real estate a ton today, but there are a couple things around real estate I want to talk about. We're going to also end on the debt to income ratio in the US and how there's all these mounting pieces of data that I think people like Michael Burry or the reason people like Michael Burry are shorting the market again. You guys remember that movie, The Big Short? I'm going to give you some of the evidence of why Michael Burry once again is hardcore shorting the market, just like he did during the 2008 crash. And it was such a popular hit that they made an entire film about it. So here we go. We're going to start off with Fitch ratings. Let me bring this up, and I'm going to explain what this is, because a lot of you guys have never heard of this. Most of us, even to know about like Experian, Equifax, these local credit companies that like rate you as an individual and your credit score, this is a very different type of report. Fitch is just like Moody's. So there's Moody's, just to kind of give you some of the names here. There's Moody's, and then there's Fitch. And Fitch is a institution that grades things like banks, countries, currencies, and in terms of their credit worthiness. And Fitch just downgraded the US once again from what did we go to? I think we went from an AA to an AA minus, or we went from a AAA to an AA plus. I can't remember where we're at. It's going to show it here in the report. But, here it is. We went from it's right here. You guys see this on the screen? We went for another downgrade from AA minus to AA or just A plus. So it's kind of weird how they do this. You go from AAA, then you go from like AA minus, and then you go from AA minus to AA plus, and then you can go to A. There's all these plus minuses in between. But essentially, it's like, to explain it to you, it's like going from an 800 credit score to a 750. And now we're at like a 700. That's how I would rate this. And by the way, personal opinion, this is bull crap. Like this should have happened a decade ago. Like the numbers and the data that Fitch uses to grade and downgrade the US, well, it's really every country's credit worthiness. It's like, this is this is old. We knew this. We knew that the U.S. was downgrading 10 years ago. We knew that the U.S. was weakening and the dollar was going to lose some of its value over the next couple of years. But I don't know who's running this stuff. Clearly, their metrics need to get read. It's like inflation. Like everyone knows when they see the inflation report, that's not reporting true inflation. Someone needs to finally go in and like update this stuff. But anyways, this is what it is. This is just the nail in the coffin, so to speak, that says, yes, in fact, this is the truth now, years after what I've been saying that this should have happened. So this is what happens. But what's concerning about this is we've already had massive downgrades in credit ratings with certain banks. And people think, in fact, I had a friend call me yesterday who was talking about Bank of America. And he's like, Matt, I'm going in heavy into Bank of America. And I kind of scratched my head, and we're going to talk about Warren Buffett in just a minute. But if you look at the numbers, it looks good, right? The PE ratio is really low. We kind of have this sense that like banks are always going to get bailed out, kind of, sort of, as long as it's not the first or the second, right? That falls. But the reality is Warren Buffett pulled out most of their shares in Bank of America. In fact, they were one of the largest stakeholders in BAC. And one of the problems with banks right now is as there's downgrades in their ratings, the stock price will fall out also because people are looking at it as like, oh, this could be another potential banking crisis or banking collapse. And when we had CREs hit the market, the world actually got really concerned about the banking industry as a whole. And so we saw a couple of bank runs, right? Silicon Valley Bank had a minor bank run, which eventually led to it, completely imploding. Because what happens is when you have old debt that's not marked to market and you have people trying to pull their cash out because of the fear that, they'll have a week or a month of not being able to pay their employees, or like the bank's going to have some issues, people want to put their money with a big bank. And so that's what happened. We've had over the last year, a massive reallocation from the small banks to the big banks. Whether it should have happened or not, this is what happened. And banks like JP Morgan Chase are just grinning from ear to ear because the small banks are freaking out. People know that they're going to have to bank somewhere. And so they're putting their money into the big banks because of the less likelihood of them failing. So this is what makes this scary, is if the dollar gets degraded, because we're in a central bank system, the banks that also manage the money it's like a domino. You can't have the dollar and the U.S. Government's Federal Reserve System get degraded and not have the banks, the little minions underneath it, not get degraded with it also. And so the potentiality with this is that there's more than, it says it right here, that Fitch is going to start reevaluating on each of the more than 70 U.S. banks that it covers. And this was a report by, I think it was Mark Wolf, but Wolf said to CNBC. So this is something I'm keeping an eye on. I don't see this being something like within the next week or 2 weeks that we're going to see like, this is not a bank play. This is not a time to go out and buy bank stocks. As you can see, even in this short video, you guys can go to this CNBC link. But you can see the banks have been taking a massive hit because of this. And it's like, I don't know if there's much more room in the play. Could you short banks right now? Yes. Could we be close to a floor? Yes. But I would just be patient. I would wait. And if you're looking to buy into banks, which, by the way, again, last time this happened, we had a crash, even during COVID. If you had bought banks during the bottom of COVID and wrote it up, like, your returns would have been insane. Sold those returns, let it come back down. Banks seem to be a fun ticker to be trading right now because they're highly volatile, but very emotionally tied. And I would even say, based on the data, easy to predict, easy to go, yeah, P ratios look good. All the numbers look good, revenues look good, but we've got this looming debt crisis, this looming Fitch rating downgrades, problems in China. I think we're in bullish or we're in bearish territory. I don't think the bulls are ready to come out yet. So I thought this was really valuable. I've got some shorts coming out about this next week. So make sure you guys are following me on TikTok, YouTube. My shorts come in all through YouTube as well. But I'm going to be giving some updates this week on this report. So there's the Fitch rating. Valuable. Banks are something I'm watching. I think buying into banks could be a massive play in the next 12 to 16 months. Again, not financial advice, but that's my opinion. All right. So while we're talking about this, and I'm not going to go and find some of the visuals on this, but I want to talk to you about Warren Buffett, one of the founders, right? Or you could say the founder of Berkshire Hathaway. And what's interesting about what Berkshire Hathaway is doing, and this, you got to get that people tie Warren Buffett and Berkshire Hathaway together like he's calling all the shots within this organization. No, he's not. But the principles that he uses are being used, right? He's using value. He's teaching his people, and the people within Berkshire Hathaway are using the principles that Buffett's always talked about, right? Value buying, value purchasing, which means you're not buying hype stocks. You're not buying stocks that are way overbought. The PE ratio makes no sense, and there's no dividends. Although he has gone into some stocks that don't have dividends. But this is kind of their play, right? They have a formula for how they go out and invest. Well, Q2 this year, there's trades going in, trades going out. There's $8 billion in shorts or sell-offs, not shorts, sell-offs that happened in Berkshire Hathaway just in Q2. So there's been more money that's gone off the table and put on the sidelines for like, hey, let's wait for another good opportunity, than's gone in Q2. And I think that says a lot about the positioning that Berkshire Hathaway has, which is a strong reflection of one of the greatest traders in all history, Warren Buffett, meaning that there's something, he's seeing something that's about to happen that he doesn't want his cash exposed in the market. So while everyone else is pushing the market up to new all-time highs, Buffett has decided to take an enormous $8 billion off the table and put it on the sidelines. And I think that's valuable to note because a lot of the data that I've been putting in, a lot of the figures and points that I'm watching really indicate that we are in kind of we call it like a cloudy territory. We've got cloud coverage. We're not quite sure if it's going to rain yet, but it's like, I'm not going out without my umbrella, right? That's fair enough. And I would say that's what they haven't taken everything off the table, right? They're still long. They're still in a bunch of positions, but to have a significant come off, one, it'd be really interesting to look at like which ones in detail. I'm not going to do that here, but two, why? Like, what are the industries? What are the markets? And we already know about the banks. We talked about that in the last one. We know that Berkshire Hathaway and Warren Buffett's position inside of Bank of America has pretty much come off completely. Now, do I think he'll get back in? Yes, I do. Has he done it yet? No, he has not. And so I would be watching if you're going to get into banks, which I think is going to be a fun play. If you're going to get into banks, I'd be watching the news and I'd be watching Warren Buffett every day, like when he gets back in, because he's no dummy and he's probably one of the best people that position in according to risk. So he's not going to be one of those guys that picks the bottom, but he's going to pick it when it starts coming back up and there's less risk on the table to position himself back into the next bull run. So I would be watching that. All right. So that covers that. I want to talk to you next, and this is going to be a shorter. I'm trying to keep these under 30 minutes now because I want to give you guys the strong data and then have you guys follow me on social for like the live up-to-date information. But we're doing a quick recap. China. We got to talk about China. China is a mess. China, gosh, I could talk about China probably for an hour actually, but let me give you the highlights. So one of the things that just happened in China this week that is alarming to me, and it has nothing to do with real estate, which we're going to talk about in China in just a second, but China, in a way, just hit like the panic button. Some people are calling it a speed bump. Some people are calling it a pothole. Some people are calling it a cliff. It doesn't matter what the analogy is. China is in trouble. And this week, they did some things that, like, if our government was doing, I would be digging a bunker in our backyard, metaphorically. Like, that's how bad it is. China this week just lowered interest rates. And it's not so much that they lowered it that concerns me, because right, we're even talking about a rate hike later this year, which, by the way, here's a little tip. My position, I was like 70, 80% sure that they were going to do a rate hike. That has probably fallen to 40%, meaning I think this rate hike, we're either going to pause rates for the end of the year, and I have a very small percent that we might even lower rates into this year, because there's so much negative data now that's coming in that we don't want to overcorrect with high rates to fix this soft landing thing that Jerome Powell's trying to do. But anyways, let me tell you what's going on, because what China is doing is actually impacting whether we will lower our rates in the next couple of months during November, September, November. So here's what's going on. China lowered rates, but typically, if you understand the monetary system, if you understand M2 and how Federal Reserve banking works and fiat currencies work and how it all works with the central bank, you understand why we raise rates. You understand why we lower rates, right? I'll keep it simple. We're not going to do a whole course on that today. But central banks and the Federal Reserve raise rates to tighten money supply to lower inflation. That's the reason they do it. Rates go up to lower inflation. That's the main reason. Now, when inflation starts going down and we start having deflation, which is typically a recession, it's typically workers don't have work, values start to drop down. We do what's called QE. We start quantitatively easing money back into the market by lowering rates. Well, China, one, this is their second time they've done this, but two, the concerning part is they did it with no announcement. Like, most people already know that there's a rate hike coming this fall. Why? Because our Federal Reserve System and the chair people talk about it 6 months in advance. They lay out a plan so that banks, institutions, individuals can start planning for, like, how's this going to impact me? Okay, I got to start crunching numbers. I got to start rebalancing my books because, rate hike might impact a refinance that I have to do or some business that, right? That's typically how a good country does things. Well, China being the second largest country in terms of GDP, like output, they're the second largest economy in the world, just did a rate hike with no announcement. No one knew this was happening. There was no priming. There was no, like, hey, here's a 2-month warning or even a month warning, a week, even a day. They gave us nothing. They hiked the rates this month and it shocked the market. And here's why. And again, opinions, but you can do your own research on this. I think my conclusions on this are correct. I think I've done enough research on this to know, but this is a panic drop. This isn't a drop because they're trying to add QE and things are, they massively overcorrected. And China has some really big issues to handle. And this is like a desperate attempt to try to get things to shift for China. And frankly, I don't think it's going to be enough. It's going to help momentarily, but it's not going to be enough. And the next thing you're going to know is they're going to be into another cycle of inflation, but it might start to go into hyperinflation, which means the whole currency completely implodes. So China is freaking out right now, and it doesn't have to do with just their monetary system or GDP. Their unemployment. Oh, here's the other thing freaked me out this week. Imagine in the US, there's all these data points from the feds, right? The Federal Reserve puts out numbers. There's all these independent agencies that put out data, right? And money supply from unemployment, right? We all have access to this. You can type it in and we have real-time, up-to-date info. Well, unemployment is something that we watch. You can get the data online. You can see the current numbers. Anyone in the public has the same data that any institution, any trader has. Well, China just started obfuscating that. Imagine that. They lower rates in a panic, and then they go, you know what? We're not giving the world or anyone even in our country unemployment data anymore. Now, I'm not a dummy, and I don't imagine any of you guys are idiots either. It's like, well, what do you think that means? You take unemployment data off, to try to hide that unemployment isn't bad. But don't you think taking it off even makes it worse? Like, it's like, and I can think of a million analogies to cover this, but it would be like having bad news for someone and then like taking the news completely off the table and being like, well, we're not even going to talk about that. We're not even going to discuss it. It's like, well, now I'm really freaking out. So the numbers have to be so bad for them to have done this. The numbers have to be so bad, or they're predicting they're going to get so bad that they don't want the public, their citizens, and the world hyper reacting to this, because at the end of the day, this is their currency on the line, and they want to still be able to lend. In order to fix their currency in their country, they've got to get people who are going to buy their dollar, right? Their dollar, the yuan. So yuan, I always say that wrong. But that's just one element of this. The other part of this that I thought you guys would enjoy is I want to show you the second, I would call this the second wave of China's real estate crash. And this is really important because a lot of people are saying this couldn't happen again in the US. You guys remember the 2008 crash, right? Well, at the same time, China went through their industrial revolution and then industrial implosion. And it created 50, not 5, not 10, 50 city ghost towns. This is 50 back. This was back during 2008 and going forward. Well, guess what? It's happening again. And the housing market, again, is crashing in China. And it's nothing light of the last one, meaning there are buildings just going completely unemptied. I want to show you some pictures. I was actually recently in China, and I want to show you just some of my pictures. And then I went online to find some of the ones that happened that are like aerials that I wouldn't have been able to get access to. So these are kind of fun. Let me show you this. So this is the picture I took. You guys can see this. This is a picture I took when I was in China. And this was, I think this is Beijing. Yeah, this is Beijing. And we were driving by, and they were, by the way, they were very clever in how they navigated us in China. Like, this was something I don't think we were supposed to see. They only took us out to certain areas where there weren't a lot of people. It was a really interesting tour. Needless to say, they're tourism events. If you're booking something and it's like sponsored by the government, this trip was partially sponsored by their government, which was really unique also. But because of that, they had a say in where we could go, when we could be out, all this weird nonsense. Anyone who thinks socialism works, go on vacation to China, and you'll see how crazy and messed up it is. But anyways, we're driving down the road, and our tour guide is this young kid. I won't say his name because he could get in a lot of trouble for this, but they're not supposed to talk politics. They're not supposed to even have an opinion. Just unless their opinion is, our government is amazing. If it's anything other than that, they're afraid of getting locked up in one of those vans and having to go get retrained as a member of society. But as we're driving down, I remember him sitting next to me, and we're driving by these buildings that look just completely empty. And if you hadn't known, you might have gone, well, maybe they're still under construction. Well, typically when buildings like this are still under construction, there's cranes everywhere, right? Because they're finishing them. Well, this one wasn't. And I remember looking at this, and this was one of like 50 buildings, guys. This wasn't like just one building. It's not a great picture, but I got my camera out fast enough to take a shot of it. And this went like 7 layers deep and like 4 layers wide of these buildings, these massive 50, 40, floor buildings that have just been completely vacated. Well, I found a top view of this one. So let me show you the top view. Here's a top view of it. And this was just, and again, I wish that you could have seen the rows, because as you're driving on this road here, it would just be building after building after building. And then as you kind of looked, you could see 1, 2, 3, 4, like 5 deep of these buildings that were just completely abandoned. Like this one right here, this is the top of another one that looks just like this. And then there's like 3 more behind it, completely abandoned. Where in the US have we ever seen anything like this? Now you've got China, who's not the first global economy, they're the second. And they're having real estate crashes that far surpass anything that I think is happening in the US. And it's happening again. We've had recently complete projects, just like we had in 2008, abandoned. Here's one, and I don't recall the city, but here's one that just got abandoned. And I didn't want to spend a lot of time on this because I really wanted to focus on like what's actually happening in China. Like how's the real estate market impacting things, along with rate drops, along with hiding their unemployment. They're saying the young people there are more unemployed than ever in the history of China. And a lot of people think we're not tied to that. Like that's not going to impact us. Well, it is. There's going to be massive impact. We are the leader. And when China has a big hit, whether we like it or not, it impacts us. And we saw the market react. Banks took a huge drop. There were multiple stocks that ended up dropping. Also, this last week, it doesn't help that we just added tech tariffs to China this week, or it might have been end of last week, but within the last 2 weeks, Biden did an executive order on specific tech stocks, tariffs in China, and it immediately dropped stocks like Alibaba and what were some of the other ones? I've got a post that's actually going out about this with like the 3 major tech stocks that dropped on this. But this is a big issue. China, we always look for indicators. The reason I'm bringing this up, we always look for indicators of like, because typically a certain market will fall or drop out before another one does. And I am watching, unlike most people, I'm watching China like a hawk because I think China is going to be the indicator. It will be the thing that falls, and the aftershock of it will be likely the thing that helps. Help is the wrong word. It also helps. It's so hard to say it without saying help, but it really ends up tipping us as well. And we're already heading that direction as we've had to deflate to bring inflation down. So keep an eye on China, guys. I'll keep you updated. Make sure you're following me on my shorts for that, because those come out like 24 hours within some of those events. All right. The next one, we're gonna have a fun time with this one, and then we'll bounce back into the US. So here's a little interrupter. I'm gonna start doing like these little stock tips in these events, things that I'm following, I'm watching. This is a stock that I'm heavily involved in the AI space. A lot of you guys know that I serve on a state panel. I've actually been recently invited to multiple boards. I'm on 2 boards right now. This morning, I got invited to a board, an AI committee that's under Tony Robbins that I accepted. So I'm doing a lot in AI, right? We built an AGI. You can use it on our website on greenchart.com. Fun story. Oh, tangent. Here's my ADHD coming out. I had a guy who just started an AI business, and he came back to me. I was on an AI panel 2 weeks ago, not state related, a different panel. And this guy comes up to me. He's like, "Hey, Matt, gosh, it's so good to meet you. Here's my business partner, blah, blah, blah." He's like, "Your AGI that you built is phenomenal." And, to me, it's like, it's okay. I've been exposed to this for a while. So I kind of lost the hype, right? I've forgotten how amazing some of the stuff is. "But your AGI is amazing, Matt." I'm like, "Cool. Like what'd you do? Were you making some trades? Did you get it?" He's like, "No, I actually used it to build my entire business model." And I was like, "Whoa, like what?" He's like, "Yeah, Kahuna. Like we just started Kahuna. $1 million back now, and the entire business model, business plan, how we're doing it, your AGI built the whole thing." And so we're basically following the advice your AGI gave us on how to build an AI consulting company, an AI auditing company. And so now he's out doing this. This is a former founder of a major tech company here in Utah, and they used our AGI, which was made for traders, to build his whole business plan. So if we have some extra time at the end, I'll show that. A lot of you guys are probably scratching your head going like, "Wait, what? You guys have an agent?" Yeah, it's actually free. I made it free to the public because I don't think charging for these things is going to get us anywhere. They become outdated really quick. We saw with like OpenAI, ChatGPT, they've already stolen a bunch of these ideas, with their plugin features, but we're still a step ahead. We still have the God mode, which I'll explain at the end, but we still have God mode, which ChatGPT doesn't, which gives it that AGI rather than AI complexity. But here's Palantir. So flashing back, here's Palantir. This is the stock that I am watching really close because there's some mixed sentiment on this. But Palantir is It's an AI stock company. So they were government contract. They've been doing this way before the hype cycle, way before. They were doing government contract work. And to give you an idea, like what they were doing, like what kind of contract work, it was mostly warfare, military. They were using AI in military warfare, and they were using the tech to plan out strategic ways to attack. So I imagine Palantir's tech is actually likely being used in the war with Ukraine and Russia. And Russia probably would have plowed Ukraine had they not had this AI that Palantir was using to strategically place troops and objectively place things so that the odds of winning would be the highest or the casualties would be the lowest. And so Palantir's had this tech for years. Well, they just opened it up to businesses. So they've opened up their AI into businesses so that now you can, you're not going to war with Ukraine or Russia, but you're going to war with your competitor, you could say. And they're using this tech for that. The CEO came out with this outlandish interview, I would say. I mean, it was like this crazy Albert Einstein interview where the CEO comes out with this, crazy hair to the side. And it's like they did this on, they've got makeup that they put him in beforehand. They're like, no, we got to make him look as crazy as possible. Mad scientist, we want people to think he's a genius. And he is, he's a smart guy. But anyways, he gets on TV and he starts telling people what they're doing. And then he just downplays all the AI stuff that's coming out. He called it, he actually said, the CEO said, we're not writing poems like ChatGPT. We're not out there doing stupid hypothetical poems and doing stuff in the language models. Like we're way past that. Like our tech is real. We put it in a bit. Anyways, the moment they did that, their stock skyrocketed. In fact, I probably should show the ticker really quick. Let's see if it's on here. I think I can come back to it. So I'm going to come back to holders. Let me show you the chart for Palantir so you guys have some historical background on this. But Palantir went from $7 to over 20. I think they hit 20. In fact, I saw some exits right at 20. Guys, 7 to 20 on a mad scientist interview. I mean, and the AI hype helps, right? But this was in May. The AI hype was happening before that. Anyways, the news worked. Their stock skyrocketed. And then what? Well, if you look at holders on this, and this is the detail, notice how this is like the last tab. It's like, people who are buying this stock or maybe get into the first couple tabs on here, but I want you to see what's happening with holders. This is the data that most people miss. That's, in my opinion, probably one of the biggest factors in how I would be deciding to buy or sell Palantir right now. And you can see with the stock, it's already dropped. Like some of this news is already out to smart people like me who've been watching, but I think there's more. I think there's more run to this bearish move than what's already hit the market. And here's what's going on. So here are the top institutional holders from Vanguard, BlackRock. I know, where is she? Oh yeah, there's Geo Capital, but massive holders, right? The largest being Vanguard at 8% holding. But when you look at, where are my insiders at? Here we go. When I go to insider roster and insider transactions, this is where things get shady. Now, an insider, just like it sounds like, an insider is someone on the inside who would be buying or selling the stock. Well, these have to be disclosed for obvious reasons. But these are people who know what's going on, right? People who know the tech, know the value of the tech, know if their stock is under or overvalued. I mean, they work in the company every single day. So that's what an insider is. This is where the term insider trading comes from. Is someone from the inside knows there's a lawsuit coming or there's a big announcement, and then they go tell a friend, right, or someone they know, and that person buys it before it comes out, before the public has access to this information. Well, the public has access to this, so there's no actual insider information on us knowing what the insiders are doing. But if you don't think that the CTO of Palantir the top person who sold the most shares in the last quarter doesn't know something, then you're fooling yourself, right? This is the CTO. This is the technology officer of Palantir. Now, look at this. He sold, guys, a sale price at 20. He hit the freaking peak, and he hit it on August 1st. And the value was almost $40 million. $40 million. And then you can see there's some direct transfers here. You've got some of the directors that are selling off, some of the other officers that are selling off, more directors. You've got the chief, you got the CEO back in June, sold 5 million. Then you have the CTO again, who sold another 15 million in May 30th. But look at this, to try to get rid of 40 million. These guys, there's something going on in Palantir that frankly, I think this shows confidence. This shows, they might have a really strong company, but they're looking at like what the public has valued it at, and they're going, man, I got to sell while it's high because we're just not worth this. And we're seeing this with the whole AI craze, guys. In fact, I would be looking at short positions on AI stocks kind of across the board right now, because there's a lot of them that frankly got way overvalued. And I'd be looking at stuff like this. I'd be looking at who are the holders. Yahoo Finance does this for free. Who are the holders? Then go to the inside transactions and see, like, are the executives selling this stock off? And if they are, that is a strong sign that they know something that you don't. They know something that the public doesn't around the strength of their company, the ability to fulfill, whatever, likely valuation. Because if they really thought the stock was going to go higher, your own company, think about this. If they really thought, like, no, it's going to go to 80, we're worth 80, that's the direction, you would hold your shares, right? You would. But clearly the sentiment doesn't show that. And Palantir, out of all the AI stocks I did research on, has the most insider sell-offs out of all the ones I've looked at. So I think there's a trade here. I think there's a sell-off trade. I think you could be shorting this stock. I think there's room to go, but keep an eye on it. And then when it starts to bottom out, because I'm in charts, I ought to be showing you guys this on green chart, but you're going to be wanting to look at support at like 14 for a possible new buy-in. We're kind of there now, but if it breaks, like if I were placing a trade, I'd be placing a trade right below 14 to go short. And then I would ride that thing probably down to $10. And that's because there's no support between 14 and 10. It just doesn't even exist. There's a little bit at like 9, almost 10, but like this whole gap, you guys can see this whole gap is the thing that you're going to want to be grabbing. And you could do it in a way that's pretty riskless, right? Get your position in below the existing price, probably at like 13-ish. Let's see if I can get an actual number here. Yeah, like 13 and a half, right? You'd be shorting it there, and you'd be taking your profits probably somewhere out at like 12 to grab that easy zone of no support. Anyways, again, not financial advice, doing your own research on this, guys, but that's a great trade tip on Palantir. All right, so there's Palantir, my fun stock tip of the day. Let's go into... and by the way, I don't know if I have to disclose this or not. I probably need to have my attorneys look at this. I do not have any positions, long or short, currently in Palantir. I think if I did, I have to disclose that. I'll get clear on with my attorneys on that. But anyways, do you guys' own research. All right, so bouncing back to our market report. So we've got some interesting data on the U.S. housing market. Without going into major detail, we did a huge report last Friday on this, if you guys remember. This next month is going to be huge, but I want to give you 2 pieces of data. And I've got some shorts coming out about this next week. I'm going to give you 2 pieces of data that you're going to hear about next month, but I think you need to know now. And it's because a whole month knowing this data can affect a lot. One is rates have just spiked at 7.1%. 7.1. It's enormous, right? It's the biggest that we've had in like 20 years. We're at like all-time record, decade highs, guys. Rates are high, which makes affordability impossible. You hear me talking about this word, affordability, all the time. But in addition to this, I want to give you 1, 2, 3 more data pieces. and then we'll recap on this next month. One is builder sentiment. So I'm going to talk to you guys about this. Let me bring this up. And by the way, without dropping names, because I like to keep my friends confidential so that they keep sharing information with me, but I'm good friends with one of the largest builders in the state of Utah. And he agrees. I was at one of our city clubs last night, sitting next to him, talking about this. And one of the things that he agreed on is the rental market is softening. It just is. And one of my other friends, who happens to be building one of the largest buildings in downtown Salt Lake that I talked with last night, is saying there are actually complexes in Utah, apartment complexes, that they have just stopped construction completely. They just stopped. It's like China, like these 80, 120, up to 200 unit apartment complexes that they have just completely stopped. The investors just pulled out. I mean, this smells a lot like the housing market crash that we had in 2008, just different components, different dominoes falling at different times. Well, this is the NAHB builders confidence chart. It shows as a builder, like if you went out and surveyed 10 builders and you said, hey, how do you feel about the market? How they feel about it now, today, is worse than it was, almost as bad as it was during the very, very worst moment in COVID. The very worst. So imagine the pure panic of COVID, right? People are freaking out. Sentiment, confidence in builders is about that level right now. You can see that we're below 40. It's dropped one of the second largest drops that we've had this year. And it's bad, guys. These are quarterly reports. If builders don't have the confidence, it's a strong reflection of where the market's going to be going. And I would say they lagged. You guys were on with me even a year ago where I was talking about this, scratching my head going, man, if builders don't make a turn, they're going to be in big trouble. They're going to be sitting on massive amounts of inventory. Well, it's happened slow enough that the inventory levels have been eaten up. I don't think they're going to be stuck. I don't think we're going to see a lot of abandoned real estate, like residential community abandonment like we did before. But the apartment ones, I think we're going to see a ton of. And here's one of the other data points I'll plug in while I'm going to my next chart. The vacancy rates, and I don't have the chart for this, but I have a short that's going out this week about it. But vacancy rates in apartment complexes, according to Zillow, just hit an all-time high. And not like all-time high, halfway as high as it was, higher than pre-pandemic levels. That's right, nationally, occupancy. Zillow just started coming out with this report, and occupancy and vacancy rates in apartment complexes, basically rentals, has hit an all-time high, and it's close to 7%. It's right about 7%, which is higher than even before the pandemic. It's higher than years before the pandemic. So what is going on? We have this housing issue. We have this problem where there supposedly isn't enough places to live, but now we've got 7% vacancy rates in apartments. Something's not adding up. Do we really have a housing problem? Do we really not have a shortage? Or is it an affordability issue? And so something's going to have to cave. Either Americans are going to have to start making twice as much money every year so they can afford this stuff, or there's going to be a massive correction in the market. And you can't have a correction with apartments. Like if the apartment community makes a massive correction, that isn't going to leave the residential side alone, right? The single family homes alone. It will all happen together. So that I'm looking at major downgrades in the housing market. Here's the next chart. This is one of the things that you guys hear me talking about all the time. And it's the thing coupled with unemployment that I'm watching like a hawk. And when I say like every time the announcement comes out on unemployment, I'm watching it. Every time we start looking at debt ratios and the new announcement comes out, I'm watching it. Why? Because it indicates how much more wiggle room we have in a really bad market. And it just isn't getting better. Like if we had a housing shortage and we were dealing with inflation, but debt to income ratio was at an all-time low and it was going down, I'd be like, well, we can handle it. We're making more money. Citizens of the US are being responsible. Not what's happening. The debt to income ratio for home buyers has hit a all-time high, all-time high, like all-time high. Here's the housing bubble. You guys see this back in 2008? Same problem. 39.1% is when we hit peak. The data points, guys, almost look exactly the same. There's so much. I don't know if you guys know this, but unemployment rates were at all-time lows right before the last housing crash. We also had the lowest inventory. We had articles and newspapers going, there's a massive supply issue in the housing market, blah, blah, blah. And then the market crashed. And it was like, wait, how did that happen? I thought we had a housing supply issue. Well, that's the same racket that's going on now, except it's worse. It's not even the same. The last report was just above the last housing bubble, and now we're at 40%. Guys, I'm feeling really bad for Americans because, like it says here, home buyer debt to income ratio, it's DTI, is the average close to 40% in 2023. Now, those are near the worst affordability levels on record, according to the FHFA. And my calculations, even worse than 2006, 2007. And it's right, it is worse. According to Reventure, this chart shows that the debt to income ratio is worse than it was then. So if I were to study history and say, okay, the reason we study history is because by studying it, we can learn how to repeat the past. Well, we are, but you don't have to. And that's why you guys are on here. You're unlike most people that participate in the market. So anyways, this is happening. I don't see how the market doesn't correct like it did last time. I don't see how we don't have some massive housing corrections. And we're already seeing it, by the way. Utah being one of the states that's leading. We had a negative year over year in average pricing. And there are people out there saying, oh, the housing market crash, that's fake news. And they're pulling like one out of 16 charts, right, to show one positive data point. Well, it's like you got to look at the full picture here, guys. All right, so wrapping things up, I want to do one more thing here. Yeah, we're kind of running out of time. Let me do this. I'm going to show one more data point, and then we'll get you guys on your way. So I want to show you guys really quick the unemployment because it is ticking up. A lot of you guys are going, well, things are still great. Numbers are still good. And that is not the picture that the data shows us. No, we want the actual chart. Let's pull this up. Come on. Sorry, guys. Here it is. And all of you guys can get access to this site, by the way. I'm just going to pull this up. We're going to end on this note because this is one of the last things that I'm watching like a hawk, because a 1% increase in this chart changes everything. And so let's just do like a last 1 year. This is the max history. This goes back to the 50s. It's important to see this because, guys, unemployment goes in waves, right? High, low, high, low, high, low, high, low, up, down, up, down, up, down, up, down. It doesn't stay low ever. Well, we hit like an all-time low of like 3.6% right before the pandemic. Pandemic hits, spike, one of the largest spikes we've seen in unemployment since the 50s. And then we come in, we jump in, we fix it. Things get right back to like 3.5% levels, 3.4, 3.5. But it is actually starting to tick up a little bit. So here's a 5-year. We hit a low of like 3.5%. We're currently back down into the 3.5% level. We had a tick up into 3.6, 3.7. And because of the summer, it's called non-farm. You have non-farm payroll, and then you have farm payrolls. Because this is the season for work, the season for farming, the season for like summer jobs, unemployment has dropped. There are more jobs. I would be watching this like a hawk during the winter, because when you include bad times, hard times, all-time debts, all-time high interest rates, and a winter is typically like that season that you're going to see a spike, just like you see in the housing market, right? We see like always, you see supply go up in the winter, you see demand drop off, you see prices usually increase during the spring and summer months, they drop off during the winter. and then go up during the early spring, right? So there's just patterns. And this is the pattern I would be watching for with unemployment. Not because unemployment has that pattern, but because the other markets do. So anytime you want, you can go to Fred's site. The domain is fred.stlewisfed.com or .org, excuse me. Or you can just type it in Google. I type in like unemployment rate chart, and this typically shows it. But this is the chart along with affordability charts or the debt to income ratio charts that I'd be watching like a hawk. And if you're watching that and we start to see a tick up, not even like if we go from 3% guys to 4% with the existing debt to income ratio, with the existing affordability issues in the housing market, all of these complex things that look really bad, but haven't hit the market yet. That's when shit hits the fan. Excuse my French, but that's when it happens, right? Shit hits the fan when unemployment goes up. It's the last data point. And you guys can see very clearly in this chart, this doesn't stay down. It never stays down. It always spikes up. And we've had massive spikes all the way up into like, what was that? A peak of 14%. Yeah, almost 15%. But, you know, even if it's a moderate hike, even into 5%, that will be enough. That will be more than enough to throw the housing market and deflationary data points back into the market, which is great for the average citizen. It helps carve back in the middle class and carve out this disparity between the lower and I would call them elite classes that have been building over the last couple of years. All right, guys. Well, that's it for tonight. For today, Market Pulse podcast. Again, great to be on with you guys. I'm going to be reformatting this just so you guys know next week. So this will be in a new format. I've got an auditor's coming in. He's going to like add some fun stuff, plugins. We're going to make this more exciting for you guys. Maybe even bring comments and questions in. But yeah, looking forward to next week. Thanks for tuning in and joining us today, guys. We'll see you here next week, same time, same place. And you guys have a great weekend. Hope your trading goes well. Signing off, guys. Thanks.